The major U.S. stock averages are hovering near flat in midday trade on Monday, but we have plenty of global event risk this week. So joining me without further ado is Peter Cardillo of First Standard Financial. Peter, great to have you here today.
Good to be back.
Well, here we are at the beginning of June, and we have plenty of event risk. All eyes will be on Thursday, where we get a trifecta of events, including the UK election, as well as the ECB meeting, and of course here in the US, all eyes will be on DC. So ahead of all that event risk, what are you paying attention to?
I think basically all those events are going to keep this market in a very tight trading range over the next couple of days. You know, we had a lower opening today, and now the averages are attempting to move on the plus side again. But I don't think we go very far from the levels of last week on either side of the equation.
And Peter, of course, after last Friday's jobs report, Fed expectations have been cemented. We are expecting a rate hike here in the U.S. by the Federal Reserve at the June meeting. But given that the non-farm payrolls did come in below expectations and the revisions to prior months, what are your expectations for the rest of the year for rate hikes?
Well, I think that there's no question that they raise rates next week, but we'll just have to wait and see as to whether or not last Friday's data was an aberration, and we get back on the track of 200,000 jobs growth, which has been more or less the average between 185 and 205. If we're not going to average lower jobs growth, then that would obviously raise a red flag for the Federal Reserve. But I think it's too early to come to some sort of a conclusion on that.
And of course, we can't discuss the markets without taking a look at energy prices. Now, in afternoon trade, we're seeing WTI and Brent futures down about 1%. Earlier, oil futures were higher, and this did come on the heels of Saudi Arabia and several other nations in the Middle East announcing that they're cutting diplomatic ties with Doha in Qatar. So what do you make of that?
Well, but what the market is actually concentrating on now, although I think it's not not in the cards, is that this diplomatic break might actually cause the latest OPEC deal to fall apart. And obviously that would just add to the supply factor. So I think that's the reason why we're seeing this negative reaction. But when it's all said and done, I think, oil prices are just going to stay within this $45 to $50 range. If you look at the weekly inventories over the past 2 to 3 weeks, we're beginning to see some real good declines, and it's not uneven as it was prior to the past 2 to 3 weeks. So, which means that inventories are beginning to tighten a bit, and eventually that will happen, and eventually the market will be convinced of that. And once the market is convinced of that, you're not going to see $40 or $50 oil anymore. You're looking at 60, 65 by year end.
Well, Peter, we'll have to keep an eye on any developments that come out, whether it's regarding oil or geopolitically. So thank you so much for joining me, and thanks for your insight as always.
My pleasure.